Okay. Hello, everyone. Welcome to Finbox FinTech Wars, a webinar series where we take up the most interesting topics in the fintech world and try to bring the right insights to you guys directly. So today we have a very important and very interesting topic, which is of Equated Daily Installments. It's an innovative product that is kind of changing the way MSME financing and small business financing works in the country, and it's really being powered by a lot of technology companies as well as very research and lenders who are backing this product. So we have gathered today a very eminent panel of guests who have worked on this firsthand and who will be very happy to share insights on this. We have Rajat Deshpande, who is the co-founder and CEO of Finbox. Finbox is the place where I as well work. I am the head of marketing and content at Finbox. Uh, at Finbox, we're basically the credit infrastructure enablers. We help companies and enterprises and lenders launch and scale very big credit products, very innovative credit products in record times. We also have Mr. Sachin Babri from Khatabook. He is the head of risk at the Khatabook's lending business. Khatabook is one of the biggest B2B apps in the country, and a lot of SMEs use it every single day. We have also Setunath C, who is the national head of brand sales at Muthoot. He's also personally worked on a lot of EDI programs, and he's also done a lot of MSME financing in his long career. So very excited to have you all here. Thank you so much for the panel to be here. Uh, Rajat, I would want to start with you and get a sense from you about what is the exciting thing about EDI. Just like tell us a little bit about this product and how different it is from an EMI product or a regular loan. What makes an EDI a standard different product?
So EDI stands for Equated Daily Installments. Some people also call it Easy Daily Installments. It is an MSME financing product where cash hitherto cash was collected on a daily basis as repayments. And this is a product that enables a lot of financial inclusion because it can the lenders don't wait for the money to accumulate over the entire month where there's a risk that people will spend it. They collect it on a daily basis and slowly pay down the loan, so the MSMEs pay down the loan slowly but on a daily sort of schedule. This has of course has come into the modern age where the cash is now collected through the payment stream that the MSMEs are getting through their code payments or their POS receivables, etc. And this is something that has taken off massively in the country, especially because of the penetration of UPI QR codes. That, of course, the UPI revolution, sort of brought as deep distribution. And given that this is such a sort of a product where the repayment is aligned with the cash flow inflow of the MSMEs, this becomes very convenient, and they don't have to worry about sort of the month end repayment. And second is, it's a very interesting product from a lender's perspective as well. One piece is that it has an early warning system built in, so if you don't sort of get daily repayments for say 2-3 days, you can understand that you have to work to basically sort of there is a risk of delinquency, or you have to work to unblock this borrower. Very few products have early warning systems built into their characteristics, so typically this works out well for everybody, and has become a very interesting product, leading digitization and financial inclusion for MSMEs at large. This is just a part of the perspective. The two gentlemen here run these businesses for their own organization as well, and we'll hear deeper perspectives from these folks as well.
Absolutely. I think I would love to come to Sachin and hear from him. What are your first thoughts when you hear EDI, and what gets you excited about this product and the potential of it? How do you see it growing in the MSME space, Sachin?
Right. I actually fully support of what Rajat mentioned just a while ago. what I'd like to add essentially is that, when we talk about EDI, we need to also think of it in the context of it becoming, we're moving towards miniaturization of lending products, right? We've seen miniaturization as an enabler for electronics over the last many decades, and how it has, made things more accessible, portable, and affordable, right? Possibly you could draw an analogy from that and say that now we are in the phase where we are going through miniaturization of loan products, which is actually leading to increase in our target addressable market, right, which is commonly known as TAM, where the affordability of a loan is significantly going up as the loans, in terms of their repayment frequency, is getting miniaturized. It's that same shampoo bottle versus sachet kind of evolution, where when FMCG companies needed to expand their target addressable market, right, they found that they discovered that if they were to package them in small sachets of 2 rupees, they expanded their market size manyfold, whereas the bottle, which possibly costs 200 rupees, had only a limited market size. Likewise, I believe the same thing is playing out in the lending industry, and very exciting times for this stage of evolution.
Absolutely. I think what you said about sachetization of credit is a very good analogy to understand how banking is actually evolving and moving to the interiors of the country. So, Mr. Setunath, I would like to come to you next and ask about your own experience and how difficult or easy has it been to kind of scale up micro lending kind of products for MSME segments.
Thanks, Mayank. Thanks, Rajat and Sachin, sharing the views. Just to start with a bit of broader perspective, all of us are aware of many known data around us. India's MSMEs population 64 million. 97-98% are small-time proprietors, and there's a credit gap of 300 to 350 billion. These data is known to all of us. Maybe we may our numbers may a little bit vary here and all there. Now, in there also, where these customers are reaching out for an informal credit. So we will generally hear the feedback or a touch base, an important aspect called the local finances present in this market, especially coming to micro MSMEs and the nano MSMEs in this market, right? So we're not very sure, what percentage, what pie of that $300 or $350 billion is actually managed by the local finances, but it's a reality. I'm sure with all our relevant experience in current organization, previous organization, these financing exist. Now, the repayment mode of these loans from the local finances is mostly our daily repayments. So that is one set of data. The large macro data is in and around us. It may start from a one-day bullet point loans, because a small vegetable vendor will take early in the morning from a local finances, be it at the end of the day. From there, it could be a 1 week product, a 10 days product, and may goes up to a 4 or 5 months kind of scenario. So that is the size, or that is a reality in front of us. From there, a lot of organizations, traditional brick and mortar NBFCs, FinTechs started building on EDI products. UPI come to the picture. COVID must have augmented the digital penetration much further. So that's a first point, recognizing wherein my experience, our own organization experience, when we started looking, there is a local lending space happening on a daily installments. It's an opportunity. This product is an opportunity actually to formalize that part of a lending, so that customer get easier products, have a more affordable rates, and technology will play a large role. And over a period of time, this started reflecting, formalizing your economy as well. So that's a first cut perspective or a feedback I like to share on this topic.
Absolutely. I think this is very important to kind of realize how big and deep this market is and how varied the needs of this market are actually. So one of the big things that has actually happened in this context is also the digitization of payments, which has taken the world by storm, and India is actually one of the leaders in now digital payments, and we are doing very well with UPI and QR code. And after the demonetization, specifically the installation of POS machines picked up really heavily. And now I think, Sachin, I would like to hear your views on this, on how POS data and payment digitization is helping products like credit to reach these segments, and especially in the context of EDI payments. Can you kind of give us an example of how effectively that flow would work for a retailer and a lender or a platform that kind of coordinates this?
Sure. So yeah, when we talk about digital payments, right, it's quite overwhelming the way we have evolved to where we are, right? And therefore, let's begin with sizing up the landscape of digital payments as we speak, right? And that will possibly help us appreciate the size of the opportunity that we can derive out of that. Today, like Setu just mentioned, and you were also mentioning, we have one of the leading digital payments infrastructures in the world, right? There are multiplicity of modes, whether it is UPI, which is the leader, backed by NEFT, IMPS, RTGS. You have AEPS, HEEM, QR, and BBPS. The list goes on. I mean, our NPCI, backed and supported by the RBI, has done a wonderful job to get us here. Right? There are also certain other enablers that have coincided with this evolution of payment modes. Essentially, we have possibly one of the highest mobile phone penetrations, and at more than 1 billion mobile phones, more than 600 million of them are smartphones with internet access, and therefore interface which can enable touch-based payments, user interface-based payments. While even now, even the feature phones have functionalities which have been enabled where digital payments are enabled. Likewise, our internet users are close to about 700 million. Right? That's twice the population of a large country like the United States. So the quantum of users, the consumption pattern itself is close to about 12 gigabytes per user per month. Right? So this clearly is a reflection on the infrastructure, and the availability of the backbone, which is the internet, and the adoption of that, which is really coincided all together, and therefore this explosion in digital payments that we are seeing over the last few years. UPI, for that matter, last month in October, we read is clocked over 730 crore transactions, right? And the value of those transactions was 12 lakh crores. These numbers are, and this is for a single month, right? So these numbers are truly astounding. And if that's the kind of flows that is going through, where people who have the access and the intelligence to read these flows, there is a goldmine of opportunity for lending, which can be derived out of that, right? And therefore, it's only waiting for lenders to develop that intelligence, actually make sharp use cases out of them, and therefore tailor their lending products to suit their target markets, utilizing this. So what I'd like to say is that the river is flowing, in fact surging. It's up to us to build the boats to sail on.
Absolutely. Could you actually, I would want Sachin, you to kind of double click on that part in terms of innovative products, right? So like today we are talking about the EDI piece. Could you also like give us an example of it, like in just like to help everyone understand like the workflow that could be built around digital payments and EDI, and how would the collections happen? How would you kind of do a daily settlement? Isn't it a very difficult process. Like I think most lenders don't want to collect loans every month on month. I think every day is a little bit much.
So one key, feature of EDI is that because it is, like it says, daily installments, the operating intensity for an EDI product is that much, far more than what you would have for a traditional EMI kind of a product, right? And therefore, if you were to set up an EDI kind of a lending framework with relevant processes around that, what you would essentially require is an access to the daily information of flows which are passing through a particular borrower or user, your ability to decipher or read those flows, understand his cash flow volume, timing, and frequency, right? With that understanding, tailor your repayment amount and possibly your repayment frequency basis that understanding. Obviously, set up the repayment mechanism via auto capture and deduction, right? Auto direct deduction through the flows. If you have if the flows flow through the same gateway that you manage, and a lot of even gateways are getting into this space because they have captive flows going through their networks, which they could actually auto debit, extract their installment, and then let the residual flow into the relevant borrower or merchant accounts, right? And therefore, post facto, beyond the operating processes as such, and we get insights into the timing of collecting for overdue accounts, right? Because quite often it's not just the regular templated payments or the repayment schedules that you could utilize this for, but also your insights into when you should time your demand for collecting from the delinquent pool as well.
Got it. I think thank you, Sachin, for that wonderful explanation of the nitty-gritties involved in running this kind of a program. Rajat, this sounds like really complicated, like really easy on the front end, but really difficult on the back end of operationalizing and doing it day on day, and especially at scale. So, what do you think, and what do you think is the possible solution to this? Like, if from a platform and a lender perspective, how do you get this going?
So, in what has happened over, say, the last couple of years is that the lending ecosystem has specialized into sort of various different players who sort of understand and build common infrastructure to be used by multiple people. So you can imagine now collection CRMs, for example, at the bottom end of the values chain in the lending sort of value chain. Collection CRMs have become standard, and then as we go along, there's FinTech infrastructure, which is what we do. Essentially enables people to sort of build robust things that are at scale, and they sort of are open to multiple players using it. And that enables the entire ecosystem to progress very fast and become more robust very, very quickly compared to each and every sort of player building the entire verticalized stack. And this is what we see in all the developed markets as well. So in the developed markets, each of the functions are specialized companies. In India right now, for example, even loan servicing is done by the lenders, etc. But in the US or in sort of developed markets, this is also actually broken out into different companies, and this is what we are seeing gradually happen in the country as well as we scale our lending to larger numbers. And one piece, of course, is the fintech infrastructure piece as a business model and as a technology piece. maturing, which is what we do at Finbox. And we enable and open this up to sort of multiple people, so that multiple companies and lenders, so that they can benefit and sort of do and run these processes more efficiently, while all the while absorbing the complexity, and sort of adding robustness to these systems. And this is what we think is one of the better courses for the entire ecosystem to develop in a country like India, because the country is very, very large. And basically looking at all of this, if we don't have standard infrastructure, then it becomes that much more difficult for people to really build out these kinds of programs. Yeah.
Makes sense. I think then, like as always, technology is the answer, but maybe not the complete answer. So, Mr. Sethu, I would like to come to you and talk about your experiences of doing micro lending products on the ground. How is there a role for technology to play there, or have you seen physical collection kind of doing better? Because there are some hypotheses that first touch contact and physical touch contact with the borrowers tends to impact the repayment rates as well. What has your experience been on this?
So my experience or my perspective is actually there is a large space for co-creation and coexistence. That's the way. So let's take two examples. You may have an existing brick and mortar, a large distribution NBFC who span across semi-urban rural market. They have a lot of branches, feet on street, must be selling multiple products, correct? So what is the advantage? They know the pulse of this market, nuances, nook and corner, existing customer base, new customer. They know the pulse. They're more of these customers are in their arm's length. May not have all the latest technology in terms of connectivity or automated payments, automated debit, or UPI facilities, which is integrated through APIs and stuff like that, which is on the other side a good fintech or a technology organization will have. So a fintech may not necessarily physically present across the geography they like to go, but they can clearly be they can adaptive geography-wise. What kind of tweaking, we call it parameterization when it comes to customer acquisition, customer selection, optimizing the loan amount or repayments, and based on the repayment behavior, then when it comes to renewal, how it need to be done. All these things comes and lies under fintech's kitty, right? So I use the word co-creation. There's a large scope, and that's what I think it's getting evolved as well. Because if you look at EDI as a standalone manual traditional way of lending, where in which, let's say, we use a base lending system and the rest all done by touch and feel and manual. You cannot able to scale it up because there is a finite capacity. Because what is specific to EDI is the biggest nuance EDI, you have to collect from every customer every day, barring few holidays, right? On the flip side, on an EMI loan, if you have 1,000 customer base, I mean, all of us know technically everything is NACH registered, 85-90% goes through bank clearing, the rest the collection start. Here you have to collect from the best of the customer, often defaulting customer, always defaulting customers, everything comes on a daily basis to you. Yeah, you may have internal, segregation, segmentation on your delinquency tracking or risk tracking and so on and so forth, but the reality. So you cannot scale beyond the limit. You cannot scale up this business even if you wish to do, if you have a knowledge, unless your technology come and play. So it mutually coexists. That's my perspective on this point, Mike.
Absolutely, I think it makes. Yeah, sure, Rajat. Sorry.
Cool. So I think Setu is absolutely correct. I think once this becomes such a high frequency activity at all layers, this becomes very, very intense, and there are so many different cases to deal with on a daily basis, and nobody can really build a process oriented solution at scale for EDI businesses. It has to be after a point in time. It has to be a technology driven sort of approach, because there is, so at the origination layer, which say the Khata book team runs, they have to educate the customer, they have to basically facilitate various kinds of deductions, etc. The infrastructure layer has to make sure there are settlements and information sort of goes to the lenders. The correct repayment behavior is reported, the early warnings are shared, etc. The lenders have to account for all these payments, look at all of the delinquency tracking, segmentation, and then their operations teams have to respond to various events of payment, non-payment, and then there are certain edge cases on extra payments. Somebody sort of at the end of the month made payments and you have to readjust it. Certain holidays are different in certain parts of the country. All of these things essentially are running in parallel on a daily basis, and you can't really manually keep sorting out stuff. If that is the strategy, it's very hard to actually build this kind of system, sort of run it at scale if on an Excel sheet. A lot of lending at like lower scales is run without technology fairly successfully, but EDI sort of, after it hits a bit, even if a bit of scale, it just goes out of hand.
Makes sense. Makes sense. I would love to hear actually Sachin on this. Actually, Sachin, could you tell us a little bit about maybe the best practices or the learnings on these kind of programs in terms of how do you kind of make sure that the customer is not feeling confused with these daily deductions? How do you communicate that, like how can one best communicate the amortization schedule to them, help them understand how the daily deductions will be made, and in some products they tend to be also be variable if my understanding is correct. So how does this whole piece gets put together?
Right. Yeah. So the key in this to make this successful is customer awareness and education of this kind of a product, because more often than not that is the key determinant both for the uptake of the product and B, for the successful repayment of the EDI product, right? So what we what we should clearly focus on is the user target segment is clearly educated that there is a repayment mode, repayment frequency which needs to be daily. What is the repayment amount? How will it be deducted? Whether it is through your QR deductions, direct deductions from QR, whether it will be dipping into your bank account. Also educating them that whatever transactions they do, they need to make sure of the volume and frequency of transactions flowing in through that repayment mode. Again, when there is a QR based deduction, you need to ensure and educate them that they need to popularize repayment through QR when they are merchants or retailers, and therefore urge their customers to do that. Display the QR codes prominently so that it's the usage goes up significantly. Likewise, even if the QR, it's not a QR backed payment, and if it's a NACH backed repayment, you need to ensure that our user base understands the value of frequent bank depositions, i.e. flows into the bank account, and therefore adequate maintenance of balances, so that this actually improves their repayment regularity. We also need to sensitize them about the the benefits of regular repayments by way of building their credit history, how it could actually improve their ability to get larger and cheaper finance going in the future, and therefore keep the pricing fair, simple, and transparent without making it too complex in terms of amortization schedule complexities, or terminologies like reducing balance and variable rate loans and flexible or teaser loans. These are terminologies which a large portion of our population would not be able to appreciate given the level of awareness or on these or in sophistication on financial products. So yes, keep it simple is what the mantra has to be when you're targeting the mass layer of our population. And in terms of the product pricing, the product, the operating front end processes, they really need to be oversimplified, and therefore a large emphasis on customer awareness and education are critical to making this a success from customer engagement and repayment perspective.
Great. I think that is the mantra for this, which is keeping it simple, like you said, Sachin. Mr. Setu, I would love to ask you this. Then why are lenders not keeping it simple and doing only EMIs, which is like a low frequency, larger ticket size credit? Why are we getting into this complicated EDI kind of loans? And the reason why I asked this question is because I would love to understand how a lender looks at this segment of EDIs. Like what is the sense that it makes for a lender to kind of go into a complicated product like this, or rather a seemingly complicated product like this?
Okay. So I'll connect the first point where we started. You will be addressing a nano microsecond of SMEs through this product. Primarily, that's a target segment which currently taking, or may not be, highly unlikely, they may not really be taking a loan from a private financer. So they used to have a habit of a daily repayment, number one. Then adding to what Sachin said in between, customer communication should be very transparent and clear, which is definitely in any segment. There's no second thought about it. Though we have all the sanction letters printed, all the printed materials, which is mentioning about the correct IRR and stuff like that. In these kind of loans, these are typically working capital loan for a short tenor, mostly. So a customer also curious to know how much interest outflow in actual terms I pay. So the people who are explaining, whether it is your feet on street staff or so any kind of digital media, for example, somebody taking a 50,000 loan for a 4 or 5 months or a 3 months through a daily, how much outflow in terms of interest goes? That's one curious thought in any small time entrepreneur will have, because that customer's intention to take this amount, put it and try to, we use it as working capital, but they say, I want to rotate that money in my business and how much money out of it after deducting this interest outflow. So that's a curious stage. The company need to answer it transparently. The second point is specifically related to last 2.5 years COVID affection. The impact of COVID happens in our economy. Many small time traders, everybody got affected. The bottom strata got more affected. Displacement happens. People lost business. So naturally, the repayments, their regular repayments, maybe for some personal loans or a car loan, two-wheeler loan, whatever it is, must have got affected. The bureau score also must have affected. So an EDI product is actually a stepping stone to rebuild the confidence back to building that score back. Because these are small ticket loans and we do it in the right way, whether it is through an assisted model with technology or either which way. These products, by timely repayment of this product, the customer can build confidence back in the in the system. Their bureau score will start improving over a period of time. So there is that kind of a relevance to a customer. So these are the couple of points I like to highlight on your question or the particular aspect.
Interesting. I think I would love to double click on this with Rajat maybe also. Rajat, could you tell us a little bit more about this piece about repayment and how do you graduate a customer from EDI? Because I think that's also one of the theses that this whole thing works on, especially in MSME lending, which is that you trust somebody for 5 rupees before you trust them for 5 lakhs. So how does it work?
So, Setu mentioned the rebuilding a credit builder nature of this product. So a lot of, different high APR personal loans that are very small ticket size also are sort of positioned as credit builder products, but they're actually not. I believe the EDI product is the real credit builder product, because for the MSME segment, because it can be as small as required, and it is sort of repaid daily, which people sort of build a habit of repaying it every day, and overall sort of work around and manage their finances such that they are able to really think of their sort of available cash flow minus the EDI repayment, and this is done and in a disciplined way every day. So the chances of default just because somebody took a meaningless risk, or really sort of was spendthrift and spent it just because he had it on him, had the extra money on himself and didn't think about it, goes away, right? And it can be a very very small product. So if you have a lower sort of credit score, and you have a shop and you have a repayment stream through, say, a QR code, etc., lender can really trust you for small amounts, and you can really repay this loan back much more easily. And once you do that, right, of course your credit bureau scores, etc., improve, and hopefully your business also is improving, given that you've taken extra sort of working capital and improved your business overall, and that is why maybe you've repaid the loan. And as your situation gradually improves and you've shown evidence to the credit bureaus and to the lenders, etc., they always have appetite to give you more credit if you so desire, at lower rates also, right? You've shown repayment behavior, which means that you are sort of eligible for better credit, and this is something that you can sort of avail for to expand your business further, right? So that is how this all works. One thing is that this is aided very very well by technology. All these signals, right, get consolidated through various sort of technology products. So for example, we have our own cross sell engine as part of our various products, which consumes multiple data streams, but this is a data stream that is very very powerful and predictive of next sort of product eligibility. So these are kind of analytics that every lender is running in house in some way, shape or form, because people always want to serve their own customers better and sort of with larger ticket size credit. So it aligns all of these interests together, and which means everybody overall benefits. So that's how you rebuild your credit, and then that's how the lenders also see this, and platforms also. So everybody has a part to play here, I would say.
Interesting. I would love to.
And, yeah. Yes, sorry.
Sure. Please, Sachin, go ahead. Yes.
Yeah, so I just thought I should add that apart from it becoming a credit builder for those who had checkered repayment histories, right? We do also need to keep in mind that it is a credit builder for those who had no repayment history, right? Just to keep it in perspective, today only about 65 to 70 million individuals have a credit bureau stamp or read on them, which means that an overwhelmingly large portion of our adult earning population has no credit history, is subject to usurious interest rates by local money lenders, and therefore unfair practices also by them, because they are entirely an unregulated sort of a community and a setup. This could possibly have a transformational effect, not just on the availability of credit, right, but also on the practices on basis of which the masses access credit, which itself is a significant delta in terms of the current experience versus the possible experience if you were to come through the organized finance EDI lending fold.
Absolutely. I think, Sachin, before I let you go on this subject, I would also want to double click on this piece that Rajat mentioned, that there is a bunch of signals that we get from a business's interaction, whether it's with the lender or with the platform. I would love to kind of understand a little bit more about whether it is a certain kind of platform or a certain kind of business, let's say a POS financing, POS-based business, which has the transaction data, which has the upper edge in kind of leading this kind of programs, or is there a certain kind of segment of platforms that can actually do better on EDI than others?
Right. So I mean, my clear thought is that the channel of flows is really not as important as the frequency of flows, right? So whether that those flows happening through a POS, a QR, or whether it is through your IMPS payments or whatsoever, right? Or for that matter, even if that person or borrower or merchant is regular to the extent that he has a very high frequency deposition habit by visiting his bank, even if that means the cash counter or the teller in where there is not much of deposit accepting ATMs in those areas, and people may not be aware of how to use them. What's really important is the regularity or frequency of flows. The channel is really it's agnostic to that, and that's where, from a lending perspective, is the key behavioral pattern which a lender would look out for, right? For that lender to have a high confidence lending program, which is objective in nature, which is technology driven, and therefore highly scalable. In absence of that, you could still lend to such customers, but then it would be that assessment based or estimation based, visit based lending, again with a significant amount of human intervention, intelligence, interaction, which is clearly a non-scalable operation when you need to scale it up, not in a few thousands, not in a few lakhs, but scale it to a couple of millions of such potential customers.
Absolutely. I think another very interesting part about this actually is that there is this perception, and rather actually a lot of data that we have in-house analyzers showed that, Mr. Sethunath, that microcredit schemes tend to perform a little too badly on the NPA space. We see a lot more defaults in microcredit, especially the government-run microcredit programs. And while they may not be the same situation with the EDI programs, what are some steps that lenders can take, Mr. Sethu, to kind of protect themselves from the defaults and keep NPA number in check? How can that be done in such programs?
One is this is more of a wish list, probably I can table across. Today, when we reach out for the market delinquency data, the most reliable source is actually the bureau, the credit bureaus, and you can actually go and purchase the kind of data cuts you want. But 99%, or I don't know, majority of them will be a monthly installment kind of a repayment trend, even if you want to take a data cut on a ticket size basis, product base, and things like that, I'm sure. And all of you are aware of that part. So one of the thing is somehow an EDI tracking need to be should come to the credit bureaus when the part of data submission, right? It's just a function of maybe adding some kind of a formats, modifying some formats of whoever the lenders are into an EDI daily product or a weekly product for that matter. That has to be differentiated from a bureau point of view. Then start looking at this data cuts in delinquency, geography, ticket size, product wise, and things like that. So I'm sure as and when these things are getting progress, more discussions are happening, and these inputs will definitely go back, and there'll be some action will be taken. I'm positive about it. Specifically coming back to the additional checks need to be taken in terms of the to keep the portfolio quality. Small ticket loans actually always gone through ups and downs. When we're talking about small ticket, we're talking about the unsecured, non-collateral based loans. It's always observation when it coming to sometimes this portfolio behave reasonably well over a period of time, and suddenly it started behaving bad. And one reason of that is all of us aware is over leverageness. Whether you call it a daily product or a monthly product, small ticket non-collateral loans always go under pressure because of an over leverageness, because there is no underlying collateral or something you can map against that. And over and above, some kind of natural calamity, let's say a flood happened in a particular state for a couple of months, it again make that situation worse. And maybe a global event like a corona either made it even worse in that way. So the natural calamity or other issue kind of situations may not be in your control. You can probably take some these cues and feedback in a part of your underwriting process, whether it is digitally or partially digital, partially manual. The over leverageness part is something lenders started keeping a check part of the lending. When you're putting your digital systems or a data science and the application on it and customer selection, where do you draw a line? For example, if I talk on a transaction basis, your particular sector, that particular sector's average turnover as per customer declaration or as per our understanding is on certain range, and the expected working capital that customer need to take, should have a broader understanding on that. So it's not about an aggressive lending and building book. It's being compassionate and being sensible. I mean, that's a long-term success that can assure in EDI business if you do it in that way. Like exactly Sachin said, too much of manual intervention, subjectivity, all this more judgmental decision will not be able to help the business to scale beyond the limit, because you have a finite capacity, feet on street. You can put it in either in distribution and sales or in collections in every organization. So technology has to play as that super layer there, right? But these inputs has to go over a period of time when these programs get matured. The system should have an intelligence to understand, what is the average, just go back to the basics, like what is an average profit margin of certain sectors. It can't be so much of difference from one state to another on the similar sector. So there are enough understanding is for us, I mean, definitely, but this has to be sharpened, augmented, so that the outcome should be mostly an optimal loan amount, and also checking this over leverageness aspect in the market. And I know we have a huge challenge. When people are taking loans from informal segment, there is no way it's getting reported in any bureaus. It can only by word of mouth or by very personal touch, you will come to know how much money I took from a personal, a local money lender or from my relatives. You can only see my bureau and come an outcome. These are the loans are running, correct? So that's a gap really exists. So somehow over a period of time, I think by formalizing these kind of products, more formalization will happen in bureau reporting, so that data itself will speak, wherein which it will able to come and defend the over leverage aspect. So that is, these are the couple of points or 2-3 points I'd like to add to the question, Mike.
Thanks.
Absolutely.
Possibly
Yeah.
And to what Setu just mentioned, right? And what you asked earlier, is that in my view, the reason why a large, your observation on microcredit or micro lending having higher delinquency rates, government microcredit programs, struggling because of the high delinquency rates, MFI industry periodically, for reasons which may be beyond predictable areas, also suffering from high delinquent rates, right? But what I'd like to say is that is the digitization of payments and our ability to access and read and understand that and build intelligence around that is a huge factor in reducing the information asymmetry between what the real or actual cash flows are of the customer or borrower versus what is the estimated or judgment-based cash flows, right? Because that's where quite often the controllable or avoidable risk lies. Right? There's for sure, there are event-based risk items which are more in the nature of government actions or acts of God, which are beyond the control of any one of us. But the controllable risk is clearly that which gets miscalculated because of this information asymmetry and digital payments and the adoption, which is deeply increasing, significantly increasing at a rapid pace. The access to availability of digital payment data by lenders, and therefore the ability to read and understand and develop intelligence about it could be a big mover in reducing the high NPAs or delinquency rates that have historically plagued microcredit sector.
Great insights, Sachin and Mr. Setunath, both on this. With this, I think I've really kind of learned a lot myself personally, and I'm sure our viewers have too. I think we will kind of end this webinar very soon, and would request you all for your closing remarks. And here's a little cue in case you need one, which is I would love to hear your thoughts on what are the ingredients of a great and successful EDI program. And unfortunately, we'll go in the reverse order, and I would like to hear from Sachin first.
Right, and EDI being a very relevant product, right, for our to massify, if I may call it, credit to the underserved, right? At the sake of repetition, I'd like to say that penetration and access to payments data is one of the key ingredients for sure, right? Apart from that, along with that, capture ability of the lenders to capture the actual payment flows through their gateways or pipelines is itself going to be crucial for our ability to successfully manage the EDI program, because given the high operating intensity, the moment there is a third-party intervention in actual repayments, that makes it that much more cumbersome, because that many more, it straight away doubles up the operating intensity. You have one at your end, and then the third party's end. Both ends have to then operate at the same frequency and intensity of repayments, right? So, a captive ability to capture repayments is a clear essential ingredient in my mind, which would ease out the operating heaviness of an EDI, successful EDI program. And also, our ability basis the intelligence to grade the repayments as per the cash flow patterns could be a big advantage in this scheme of things, right? Quite often, although your repayments may be on a daily basis, a moot question which a large section of our population may have yet is, or a large section of the lending community is yet to solve, is that can we not make it equated, although daily, right? Can you custom tailor it to move it beyond an E in the DI, right? Beyond the equated in the DI to make it to play on the abbreviation itself. Can you make it NEDI, which is the non-equated but daily installment, right? I think so. That's something which could tremendously popularize and make this successful as a product as well. And last but not the least, right? I mean, I truly believe that the basis of lending is building trust, right? Without that, nothing exists in lending. therefore making it simple, right? Keeping it simple, transparent, keeping the communication channel rigorous, as well as customer friendly in the manner and in the channel in which they have best access and understanding of, would go a very long way in making the daily installment product a successful one.
Great. Thank you so much for those thoughts, Sachin, and thank you so much for coming on the webinar and enlightening us a lot today. Mr. Setu, any parting thoughts?
Yeah, definitely EDI product is here to stay. This is for the masses, definitely. The journey will be an assisted journey, mostly co-partnering between the conventional or a large NBFCs or a mid-sized with the FinTech partners, wherein which the data which is gathered, the ability or the quality of the data actually work as a reverse feed to improve the customer offering or profiling of the customer. Bit of word of caution, if you want to really sustain in an EDA business for longer, whenever you do a trade-off of where do you want to deploy people first, you can be more digitalized on an acquisition front or a assessment front. But when coming to receivables collection front, you should have a kind of at least it depends on organization kind of a collection structure till you reach a level of comfort and you see few cycles and how the delinquency trend, the defaulting trend behaves across sector, or how does it going to affect your, there is a credit cost to everything what we do, right? So that point, because you have more daily collections hit, you're assuming end of the day you have a positive assumption based on data that I'll be able to collect through the UPIs or QR codes or IMPS or internet banking or anything you speak. But always in a lending, things can go out of track. So you need to be prepared in some initial phases. That depends each organization's comfort level to decide on that. Then move into 100%. Even if I'm talking about, even if you have a capacity and capability for a digital collection, still you should have a backup strategy on collections on wherever required you need to step in and do, because we've seen these cycles coming and hitting and going many times. So these are the points. Rest we already covered, and all Rajat and Sachin really shared some good inputs, which was a learning and eye opening for me as well.
Absolutely, I think we've really learned a lot from you as well, sir. With that, Rajat, please give the closing
So yeah,
address.
this is super. As enablers in the ecosystem, it is exciting for both lenders and platforms to come together and sort of be super open to collaborate and learn from each other. I think there are exciting times ahead. I think the unlock on EDI happened due to coupling of the payments processes with lending, and at a micro structure level of the lending value chain, it changes certain things very, very fundamentally, which is essentially sort of bringing in repayments at very low cost, creating an early warning system, enabling partnerships with people who have already created a distribution with payments. All of these things really fundamentally change also fintech infrastructure, stuff that we are trying to build in the market and sort of enable people as independent business model, which is sort of creating a little bit of trust and enabling and connecting both sides of the aisle. I think this is a very exciting time for this product, given also that it is really aimed towards the MSMEs and towards the lower tier of MSMEs. And I would say we have barely scratched the surface, because the transformation in the systems of the lenders and the platforms has just started. There are large success stories in the market, but they're still very small compared to the huge potential that this country has. And we believe this will be a transformational product, and I tell everybody that this is my favorite product, and we really want to crack open the market and see how long and to where it can run to. And we believe that a very, very small strata of lenders have actually tried this also, right? and we believe that that will definitely that creates a wide space in the market with a lot of competitive advantages for lenders such as Muthoot, with a large branch network, with an existing sort of experience in the product, with certain systems already set up. And we believe as this market gets discovered, it will be very good times for sort of the MSMEs trying to sort of come up the credit curve, so to say. So we're very excited at Finbox to build through and assist the ecosystem to build this product and sort of get it right. And yeah, those are my parting thoughts, I would say.
Great. Thank you so much, Rajat, and thank you so much to our panelists, Mr. Setu and Mr. Sachin. It's been a great conversation, and thank you to all the viewers for watching. And if to read more, you can head on to our blog at Finbox. We have a very detailed, in-depth blog on EDI. And please do keep tuning in for these webinars. We'll be back very soon with something more interesting for you. Thank you so much.
Thank you.
Thank you. Thank you.
Thank you.
Thank you.
Thanks, Setu. Thanks.